A Warren Buffett favorite, Hewlett Packard, did warn of slowing consumer spending in the current year. And the stock is down over 20% year to date. So the question is it now time to buy this stock? That's what we're going to cover in this video. So guys, smash that like button, subscribe if you're new. You're watching More Money. Let's get it. What's up guys, and let's get right into this video because it's very interesting. Hewlett Packard warns that their business could potentially be slowing as business spending and PC sales are starting to stagnate. However, they are still seeing long-term PC demand remaining above the pre-pandemic levels. And in the article, the Wall Street Journal did say that sales have declined in the last quarter, and the PC maker cut its outlook as it joined a growing list of companies to report a slowdown of consumer spending. And their chief executive officer said that the worsening consumer demand is expected to continue, and the company is seeing business appetite softening in the current quarter. And you can see that's partially the reason why the stock pretty much fell off the cliff on this release, and shares are down now over 20% year to date. And you guys might recall that in Q1, Berkshire Hathaway was actually a buyer of the stock, while the other super investors have largely been selling it over the last couple of quarters. So the question is this an opportunity where we should be purchasing the dip? Well, I do want to start with what exactly is their business? Well, you can see that their last year business mix is 32% in printing, and the printing business is a much higher operating margin business at 18.1%. And the sale of PCs is approximately 68% of their business or of their revenues. And that personal systems business represents a lower operating margin of 7.2%. And so you can see, because the variances in those operating margins is pretty much a 50-50 business, where printing is 55% of the overall operating margin and personal systems is 46% of the overall operating margin. Now let's just dive into the personal systems quickly. Notice that the personal systems is made up of notebooks, desktops, workstations, and other, which is approximately 4%. And notice that in that middle chart here, you can see that the revenue and operating profit margin trend is declining. Well, you're not seeing the revenue trend decline just yet, but you did see the operating profit margin decline as a percentage of revenue in the fourth quarter of 2021. But the read-through, at least from Corsair's release on desktops, I know these are different markets, is that there's just slower demand right now as a result of a more cash-strapped consumer and a result of a more cash-strapped business consumer, because one of the areas where businesses can reduce spend as they think about the back half of this year is on CapEx for employees. And so this is one area where people might just have to hold on to their older laptops for longer. And with their printing segment, remember guys, that this segment has overall lower revenues, but it's a higher amount of profitability. And in fact, it's 54% of the operating profit for the company. Notice that 63% of the business is supplies, 22% is commercial, and 15% is consumer sales. Now, I think overall this segment will remain relatively stable. It probably could decline just a little bit just from lower business activity as a whole, but I think it's more stable than the other segment. But it doesn't matter what I think. What does the company think about their business and forecasting out into the future? Well, you can see that overall the company expects low single-digit revenue growth. They expect the personal systems margin to be around 5 to 7%, and they expect the print margin to be around 16%. Notice that this is a free cash flow generating machine. They expect to pay back 100% of that free cash flow through either share repurchases or dividends or both. And notice that they do expect to maintain some form of gross leverage ratio. So they're maintaining some amount of debt on their balance sheet. So think about not completely penalizing the company's valuation for the full amount of debt. You guys already know in all of my valuations, I penalize them for 100% of that debt, but I'm very conservative with the way I model out companies, but you don't have to be. So let me know in the comments what your valuation is coming to based on sort of how much you're penalizing them for that debt. But the question is, that's their long-term outlook. Where do they see EPS coming in this year? Well, you can see that they are forecasting that their diluted net EPS to be approximately $3.50 per share this year, or they expect free cash flow to be around $3.2 to $3.7 billion. Now, that $3.50 per share reflects a 8.5 price to earnings multiple for this business, which I think is very low. And notice that it's largely been a steady growth, steady margin type of business. And the gross profit margins have largely maintained around 19 to 20%. So it's pretty steady Eddie as it goes. And I expect them to grow revenue slowly into the future at around 3% overall. And I could be forecasting the gross profit margins individually, but I'm just holding it steady Eddie at around that 21 to 21.5% range. So I think that's pretty reasonable relative to where this business trajectory is headed. But what does that mean for their valuation? Well, before I get into the valuation, remember guys that approximately 80% of the viewership of this channel comes from people that are not subscribed. So please, if you have a second, hit that red subscribe button and hit that notification bell to be notified when I upload great content. Now, here's where my valuation lands. I'm valuing this company using a terminal multiple of 12.5 times. That might be a little bit low, but I think it's reasonable based on my expectation of the business. I am penalizing them for the debt that they have on their balance sheet. So overall, I think this is around a $45 per share business. The current share price of $29 per share does reflect an 8.2 earnings multiple, or reflects a 12.2% earnings yield. I would love to buy this business at a 15% earnings yield minimum. So I'm going to hold out for the share price to come a little bit lower. But what do the cash secured puts look like in this environment? Because I might just be able to pick them up for cheaper. Well, remember that I'm valuing the business at approximately $46 per share. So I want half of that. So the $23 per share cash secured puts. So that's what I'm looking at the January 19, 2024 expiration date. The $23 per share cash secured puts are only yielding around 8%. And the June 2023 cash secured puts, which you don't see here, are yielding approximately 9%. So nothing exceptionally competitive at the moment. I'll wait for the share price to come down a little bit more. I know there's going to be a lot of you guys in the comments saying, hey, listen, that's a little bit greedy. The shares are really low and it's a pretty stable and growing company, at least like relative, like 3% every year, pretty stable. I get it. I'm just greedy. And so that's why I'm going to wait a little bit. But I do have my eyes on this one and I'll add it to that sort of like dividend side of the portfolio. Now, the question is, how do you get access to this model and all the other models that the Patreons get access to? Well, you can get access to that model at the lower tier of the Patreon level. And if you want to join us for an epic live presentation, you can join us at the higher tier. Now, if you're looking for a slow grower, high dividend yield type of company, Paramount might be right up your alley, and I actually made a video on them, which you can get to right here.